Sandra is a retired teacher from Burlington, Ontario. Last spring, she sold the family home, the house she'd raised 3 kids in over 26 years. She made $890,000 in profit. Every dollar of it was completely tax-free under the principal residence exemption. She went out for dinner to celebrate. Then her accountant called and asked for her T2091. Sandra had never heard of it. Neither have most Canadians, and that silence cost her $2,400 on a sale where she owed the CRA absolutely nothing. Here's what happened. Before October 2016, if your home was your principal residence for every year you owned it, you didn't have to report the sale to the CRA at all. The gain was tax-free and the paperwork was invisible. Most Canadians who bought homes in the 1980s, 1990s, or early 2000s grew up with that understanding and never updated it. Then the federal government changed the rules. Starting with the 2016 tax year, every Canadian who sells a home must file 2 forms, Form T2091 and Schedule 3, and report the sale on their tax return, even when the entire gain is tax-free, even when you owe the CRA $0. Miss those forms and the penalty starts the day after your filing deadline, $100 for every complete month overdue. The maximum penalty is $8,000. Sandra filed late. Her penalty was $2,400 on a completely tax-free sale. Most homeowners never find out about this rule until they're already offside. Their real estate agent didn't mention it, their bank didn't mention it, and their accountant assumed they knew. That gap is exactly how Sandra ended up paying $2,400 she never should have owed. If you sold your home in 2025, that form is due April 30th. Now here's where this gets significantly more complicated and more expensive. If you own both a home and a cottage, pay close attention. The principal residence exemption only covers one property per family per year. You, your spouse, and your unmarried minor children can only designate one home as your principal residence for any given year. You cannot shelter both a home and a cottage at the same time. Here's how the trap works. Suppose you sell your cottage first, and you designate it as your principal residence for all the years you owned it. The gain is fully sheltered, no tax. That feels like a win. But those years of designation are now gone. When you eventually sell your home, only the remaining years are available. The formula for how much of the gain is sheltered depends directly on how many years you can designate, and if those years were already used on the cottage, a significant portion of your home sale becomes taxable. Sandra and her husband owned a Muskoka cottage for 10 years alongside their Burlington home. If they had used all 10 years of cottage designation, only 16 of the 26 years of homeownership would remain for the Burlington property. The result? A taxable gain of over $307,000 on the home. At their marginal tax rate, that's roughly $66,000 in unexpected tax on a property they assumed was entirely free and clear. That's a number most Canadian homeowners never see coming, and it's entirely avoidable, but only if you plan before you sell, not after. Here's what to do right now. If you sold your home in 2025, log in to CRA My Account and check your filed return. Look for T2091 and Schedule 3. If they're not there, file them immediately or call your accountant today. If you own both a home and a cottage and haven't sold either yet, book a meeting with a tax professional before either property goes on the market. That one conversation could save you tens of thousands of dollars. And if you've already missed the T2091 filing, there's a CRA program called the Voluntary Disclosures Program that can reduce or eliminate the penalty entirely, but only if you come forward before the CRA contacts you first. Every month you wait adds another $100 to the bill.